What gives money its value? Is it the trust we place in it, the physical commodity it once represented, or the belief in the institutions that print it? Can a monetary system ever truly guarantee stability, or is it bound to collapse under economic pressures? These questions lie at the heart of one of the most influential and controversial systems in history, the gold standard. For centuries, this system governed global finance, shaping economies, guiding governments, and providing a universal measure of value. But why did it eventually fail? Could it make a comeback today? And what lessons does its rise and fall offer for the future of money? Gold has always captivated humanity. Across centuries and cultures, it has symbolized power, wealth, and permanence. But why gold and not another commodity? The answer lies in its unique properties. It is scarce, durable, and universally recognized for its intrinsic value. Unlike perishable goods or even other metals, gold does not tarnish or degrade over time. Its beauty and luster have made it desirable, while its rarity ensures that it retains value. Long before the concept of paper money or digital currencies, gold coins served as a universal medium of trade, facilitating commerce across vast empires and connecting disparate economies. The formal adoption of the gold standard as a monetary system began in the 19th century during an era of rapid industrialization and global trade. In 1821, the United Kingdom became the first country to adopt the gold standard, tying the value of its currency, the pound sterling, to a fixed quantity of gold. This was more than a financial reform. It was a declaration of economic integrity. By ensuring that every pound in circulation was backed by gold, Britain sought to establish trust in its currency. The system created predictability and stability, qualities that resonated strongly in a world increasingly connected by commerce. But was this system as stable as it seemed, or was it a rigid framework that would crack under pressure? Britain's success with the gold standard set a precedent, and soon other nations followed suit. By the late 19th century, the gold standard had become the dominant global monetary system, with countries like the United States, Germany, and France aligning their currencies with gold. This created a unified framework for international trade, enabling merchants and governments to transact with confidence. Exchange rates were fixed and inflation was kept in check, fostering a sense of economic order. For a time, the gold standard seemed to be the perfect solution to the challenges of global trade. But was it truly as flawless as its proponents claimed? The gold standard operated on a simple yet rigid principle. A nation's currency supply was directly tied to its gold reserves. Central banks could only issue money equivalent to the gold they held, creating a self-regulating system that limited inflation and maintained currency value. This discipline was seen as a strength, forcing governments to exercise fiscal restraint. However, the system's rigidity also meant that economies had little flexibility to respond to unexpected shocks or crises. The first major test of the gold standard came during World War I. The war's staggering costs forced governments to suspend the system temporarily, as nations printed money to finance their military efforts. Inflation surged, and economic disruptions became widespread. When the war ended, countries attempted to return to the gold standard, but the global economy had changed irreversibly. Could the gold standard adapt to this new reality? Or was it destined to become a relic of the past? The interwar period exposed the gold standard's vulnerabilities. The Great Depression of the 1930s delivered a severe blow, as economies around the world collapsed under the weight of financial instability. Countries hoarded gold, devalued their currencies, and enacted protectionist policies in a desperate bid to safeguard their economies. These actions deepened the crisis and revealed the gold standard's inability to cope with global shocks. Was the system inherently flawed, or was it simply overwhelmed by unprecedented circumstances? In response to these challenges, the Bretton Woods Agreement of 1944 sought to create a new financial order. This system, named after the conference held in Bretton Woods, New Hampshire, established the US dollar as the world's reserve currency. The dollar was pegged to gold at a fixed rate of $35 per ounce, while other currencies were tied to the dollar. This arrangement preserved some elements of the gold standard while introducing greater flexibility. However, it also placed enormous responsibility on the United States to maintain the system's stability. Could the U.S. uphold this role, or was the new framework destined to unravel? By the 1970s, the strain on the Bretton Woods system had become unsustainable. The United States faced mounting inflation, a growing trade deficit, and the financial burden of the Vietnam War. In 1971, President Richard Nixon made the historic decision to suspend the dollar's convertibility into gold. This effectively ended the gold standard and ushered in a new era of fiat currencies. While this move provided governments with greater flexibility to manage their economies, it also introduced new challenges, such as the potential for unchecked money creation and inflation. Was abandoning the gold standard a necessary step, or did it mark the beginning of a more volatile financial era? Today, the gold standard exists only in history books, but its legacy continues to influence economic thought. Advocates argue that a return to the gold standard could restore fiscal discipline, curb inflation, and provide a stable foundation for global trade. Critics, however, contend that the system was too rigid and ill-suited to the complexities of modern economies. Could a modern version of the gold standard work in today's world of digital currencies and decentralized finance? Or is it an outdated relic with little relevance in the 21st century? The rise of cryptocurrencies has reignited these debates. Bitcoin, often referred to as digital gold, shares many characteristics with the gold standard. It is finite, decentralized, and resistant to inflation. Proponents argue that Bitcoin offers an alternative to fiat currencies, combining the stability of gold with the technological advancements of the digital age. But can a digital asset truly replicate the trust and stability that gold once provided? Or is it simply the latest experiment in humanity's quest for a reliable monetary system? As we navigate the uncertainties of the 21st century economy, the story of the gold standard offers valuable insights. It reminds us that money is not just a tool for trade, it is a reflection of trust, discipline, and shared values. The gold standard may no longer govern our monetary systems, but its principles remain relevant. The questions it raised about value, stability, and the balance between control and flexibility continue to shape discussions about the future of finance. So, what does the future hold for our financial systems? Will we embrace new technologies like blockchain and decentralized finance, return to old principles like the gold standard, or forge entirely new paths? These questions remain at the heart of the global financial conversation, proving that the legacy of the gold standard is far from forgotten. It is a story of ambition and limitation, of trust and collapse, a reminder of where we've been and where we might go.